All right, let's dive in. Today, we're going on a quest. We're going to look right past the crazy, chaotic, up and down noise of daily stock prices to figure out what a business is actually worth. Let's get started.
You know, the father of value investing, the legendary Benjamin Graham, he nailed it with this quote. In the short term, the market is just a popularity contest, a voting machine. But over the long haul, what really matters is substance, its true weight. And our job today, it's to find that weighing machine number.
So, here's our game plan. First, we'll learn to separate all that market noise from what's real. Then, we'll get to the heart of what a business is actually worth. After that, we got to account for two huge factors: time and risk. Then we'll put it all together into the big formula. And just when you think we're done, we'll pull out a secret weapon from a master investor and finish up with a super important reality check.
All right, first things first. We have to draw a really clear line in the sand between two totally different ideas: the market's mood of the day and a company's real fundamental value. They are not the same thing, not even close.
Think of it like this. The market price is what you can buy a company for right now. It's emotional, it's jumpy, it reacts to every little piece of news. But intrinsic value, that's what you should be willing to pay. It's based on something solid and analytical, a company's power to generate cold, hard cash over time. Our entire mission is to ignore that emotional noise and lock on to the analytical signal.
And here it is, the official definition of the treasure we're hunting for. Intrinsic value isn't some magic number pulled out of thin air. It's a calculated guess. It's what a totally rational person who's done their homework should pay for a business. It's all about one thing: the cash it's going to spit out in the future, but translated back into what that cash is worth to us today.
So let's keep going. We know our goal is rooted in cash. But what kind of cash are we talking about? And how on earth do we measure it? This is the first big clue we need to solve our puzzle.
So, what's the tool the pros use? Well, it's pretty amazing how much they agree on this. A whopping 86.9%. Basically, 9 out of 10 of professional analysts use something called the discounted cash flow model, or DCF. Why? Because it zeroes in on the one thing that truly matters: free cash flow. That's the cash left in the bank after a company pays for everything it needs to run and grow. It's the money that could, in theory, be handed out to all its investors.
Okay, so we've got our first ingredient, future cash. But there's a catch, right? A dollar you're promised next year isn't worth the same as a dollar in your hand right now. We have to figure out a way to account for that weight and for the risk that, hey, maybe that dollar never even shows up.
This is where the discount rate comes in. It's a really cool concept. Think of it like an interest rate in reverse. It helps us take that future money and figure out its value in today's terms. And the riskier the company, the higher the discount rate we use. Now, the gold standard for this calculation is called the weighted average cost of capital, or WACC. And this chart shows you exactly where that WACC comes from. See, a company basically funds itself in two ways. It can sell off little pieces of itself, that's equity, or it can borrow money, which is debt. WACC just takes the cost of each of those, the equity and the debt, and blends them together into one single powerful number.
Whoa, okay, here's the formula, but don't let your eyes glaze over. Seriously, forget the math for a second and just focus on the logic. All this formula does is blend the cost of that equity and the cost of that debt together. It just weighs them based on how much of each the company uses and throws in a little bonus for the tax savings on debt. That's it. The result is just one number: the company's total blended cost of raising money.
All right, it's time for the main event. We've got our two critical pieces of the puzzle: our best guess at all the future cash flows and our discount rate, that WACC we just figured out. Now we put them together and find our answer.
So this DCF journey really happens in two parts. For the first few years, say 5 or 10, we do our best to make detailed year-by-year projections of that free cash flow. We call that the explicit forecast period. But after that, well, we can't forecast forever. So we calculate something called a terminal value. It's one single number that represents the value of all the cash flows from that point forward, basically into infinity.
Now, get ready for this, because this is the part that just blows my mind. That terminal value, the number that represents the super distant future and is based on a really simple, broad assumption, it often accounts for 60 to 80% of the company's entire calculated value. Let that sink in. The biggest piece of our puzzle is the part we're the most uncertain about. So, we did it. We ran the numbers. We have our estimate of intrinsic value. Does that mean we should rush out and buy the stock if the price hits our number? No way. This is where Benjamin Graham comes back in with one last and maybe the most important tool for our quest. He called it the margin of safety. And honestly, if you remember just one thing from all of this, make it this. It's a buffer. It's a discount that you demand between what you think the business is worth and the price you're actually willing to pay. Think of it as your financial seatbelt. It is your ultimate protection against being wrong, because you will be wrong sometimes. This chart shows it perfectly. Your super detailed analysis says the stock is worth $100. Great. You don't buy it at 95. You wait. You wait until maybe you can get it for 70. That $30 gap, that is your margin of safety. It's the simple art of buying a dollar for 70 cents. It gives you a huge cushion just in case your valuation was a little too rosy or if things just go unexpectedly sideways. And this brings us to our final and absolutely crucial reality check. After all this math and all these formulas, it's so tempting to think we've discovered a hard scientific fact. But we haven't. What we've built is a very precise-looking estimate that's built on a foundation of assumptions.
Just look at what happens here when we start poking at our assumptions. If we just bump up our discount rate from 9% to 10%, just 1 percentage point, our final value drops by 15%. Or if we shave just 0.5% off our long-term growth rate, the value falls by 12%. This just goes to show how incredibly sensitive our final number is to the guesses we put in at the start. So that really leaves us with one big final thought to chew on. The valuation number we come up with, it's just an estimate. It's the output of a model that is full of our own biases and guesses. But the margin of safety, that's a discipline. That's a rule you follow no matter what the spreadsheet says. So the real question isn't just, what's this thing worth? It's, how big of a cushion do I need to protect myself for when my estimate, inevitably, is wrong?